Ladies and gentlemen, look at that transition. Holy. That was like less than 10 seconds. Anyway, I'm joined here by the great and powerful Tevis, Fundamentals of Investing podcast. Let's not forget where your roots came from, Tevis. We know your real name.
It's literally right behind me.
Well, yeah, but it doesn't say the podcast part.
Did you go live because I had inappropriate music blasting?
No, I didn't even hear that.
Thank God.
What is inappropriate music?
Well, let's just say it wouldn't be good for your stream.
Steven just listened to gangster rap all day.
I mean, last time he had music on, he was listening to like Fat Joe, I think.
I just put it in the private chat.
Okay, let me see. Oh, well, you sent me a link.
It's going to start playing as soon as you click it.
Yeah, do not click it.
Okay, cool. Steve's an interesting character. All right. We got a lot of topics to talk about. We could talk about the draft. We could talk about InvestAmerica. I want to hear your thoughts on that, Steve, if that makes any difference for you for companies like SoFi or even JP Morgan. Oh my gosh. Ladies and gentlemen, I was not expecting this. I thought you couldn't make it.
I sent you a message.
Oh, when?
Like 10 minutes ago. Yeah.
Oh, I was live.
Yeah. Yeah, no, I didn't think I could make it either. And ended up just coming in the door. I'm like, hey, what else do I have going on, right?
Awesome, man. I'm glad you could join us. This makes it a lot more fun. We got a full house. Do you guys want to talk about InvestAmerica?
Yes.
Roy does. So actually, Roy, do you want to take us off? Why don't you explain it?
Give me 1 second. One more change. There we go.
I literally was dealing with this my whole last stream. Just a bunch of people saying that I didn't end up picking SoFi for the draft, and now people are talking about it again. Ladies and gentlemen, I'm sorry.
Pick SoFi for the draft.
I wanted to.
No, you didn't.
Yes, I did. I didn't think anyone else would pick it. I knew you weren't going to pick it.
Cop out.
You literally picked new above SoFi. Nobody was ever going to pick new.
Chris was. Chris loves new.
I love new. So InvestAmerica is originally floated by Brad Gerstner, and it's this idea, in essence, to give every child that's born in America that has a social security number, so that's naturalized citizens and legal permanent residents, $1,000 at birth that parents cannot tap into. It cannot really be taken out for the most part until they're 18 years old. And at 18, there's only selective things that they can be used to start a business, to fund education, to buy a house, those sort of expenses. Otherwise, it sits in there until the age of, I believe it was 29, 30. And at that point, it can be taken out for anything or just rolled over for additional investments. It's if money is contributed in it, so it can be up to $5,000 a year by parents, grandparents, whomever, employers as well. That is kind of like a Roth in the tax-free, but it's on top of a Roth. Critics have said, hey, it disproportionately helps the wealthy, but I mean, it's $1,000. And as far as like benefits and beneficiaries, the reason why we're bringing it up, it's in the supposed big, beautiful bill. So if that passes without modifications, then this will be a part of it. Trump, of course, did kind of hijack the process and called it Trump accounts. So if you hear Trump accounts, it's the same thing. And there's some big ramifications for many companies, including SoFi and Robinhood.
Could I ask a quick question? You said it disproportionately benefits the wealthy. Is that because it can be funded?
Yeah, because you can add money to it. So okay. It's like, yeah, the wealthy have money to fund their child accounts. So, but I mean, they're already wealthy. So what are you going? It's silly.
Yeah, and they could also just do that themselves and then gift them. And yeah, anyway.
I mean, like, yeah, you can put the argument on like every child gets a cookie. And it's like, well, but the wealthy can buy a lot of cookies. It's like, yeah, but every child at least starts out with a cookie. It's like
and the wealthy can do that today if they wanted to. So
exactly.
Yeah, but there's a big difference with that, though. So the wealthy cannot add to a Roth for a child. It's only can be a taxable account because it's very hard to prove that a child has a real job. Like there are safeguards. So now, obviously, there you can, if you have your own company and you can basically get away in an audit that your child is distributing the mail in your office and you're paying them for a summer job, that's one thing. But it's very hard to get for somebody to get a Roth under 18 years old, or even you want to play your devil's advocate 16 years old. It's very hard until they have at least working papers.
Yeah, there's like 503 plans.
Yeah, but that's for college. That can only be used for college. That doesn't count.
Well, unless they don't go to college, in which case it can be used like older. There's backdoor Roths later. Like it is another tool, another vehicle, but like I don't know. Those that are saying it disproportionately helps the wealthy, it's like the wealthier wealthy, they're going to do well. So
Yeah.
But implications for Robinhood and SoFi. So Tanner is of the opinion that this is absolutely a nothing burger for Robinhood, and it's okay for SoFi. And I'm like, hey, you're absolutely wrong. In essence. Well, I guess to give a little bit of context, this really
is what I'll add, by the way.
Until 2029. So it's 4 years. And after that, it phases out unless it's passed again. And it's only banks and I forget the term, but trust agencies, including Robinhood, including like a bunch of like specialized like Christian this and firefighter that. There's like 5 pages of them that are already approved by Congress, not specifically for this, but it's using a definition from another. You guys can look up the almost over 1,100 pages in the big, beautiful bill. And it's right in there under Trump accounts. So
is this amount the moment that like of the account inception, is the amount going to be invested into the S&P, or can you choose something else? Can you sell it from the S&P and buy something else with it? Or does it have to stay locked?
It's a broad-based ETF, so it doesn't have to be S&P 500. It can be like NASDAQ, probably Russell 2K, that sort of thing. There needs to be, I think, a little bit more framework on what this can be, but it's a broad ETF. It's not individual assets.
So basically, I'm going to have a special account, all my banks or brokers, whoever I'm doing it with, and it's going to be like the InvestAmerica account or whatever, and all I'm going to see in the options are, and all I'm going to see in the options are a bunch of ETFs, and I can buy and I can sell and I can't withdraw, but I can deposit.
Yes, that's correct. And there are like certain provisions when you can withdraw, but it's very rare. There's tax penalties. That's really not what that's for. And let me just show off real quick the user interface that Robinhood has. They're not going to be the only ones. Some Robinhood investors got excited and they're like, yeah, this means it's going to be all Robinhood. Now, by the way, which CEO, Robinhood CEO Vlad Tenev or Anthony Noto of SoFi is on the chair of CEOs for this?
Anthony Noto.
So SoFi is going to be certainly involved, but like really like every bank and everything that's a trust agency. Now, Robinhood, slick user interface. I don't know that I can zoom. Yeah, it's not really going to let me. But this is 15 seconds. It kind of just shows some things. I'll pause it. Claim your $1,000. There's going to be a little bit more to it than this because you have to put in the social security number. Only one can be claimed. And there's a lot of rules, by the way. If you try to claim multiple, you're going to get hit. So now what's interesting there, and I don't think that this is what's going to be able to happen, is having these individual holdings, unless there's something that I'm misunderstanding. This is just showing off the interface real quick. They have this lovely, and I love this part. This is from Robinhood Strategies. It's the same tool that they have showing if you contribute $5,000 a year or less, what that looks like up until the 30 years when it has to be withdrawn, rolled over, or whatever. So it really shows people compounding, what compounding gains really looks like. And it's just a snappy interface. I mean, they do a great job of it. So those are going to be ready, I'm sure, day one, not just from Robinhood, but a lot of others as well.
So how have they made mention of how they're going to be splitting the accounts? So let's say, JP Morgan, Wells Fargo, Robinhood, and SoFi are all competing for these accounts. Is it an equal distribution across the four? Is it whatever the parents
it's wherever the parents want to side them up.
Yeah.
Wherever the parents decide. Okay, got it.
Yeah. And the genius of that is basically the government doesn't have to do any kind of marketing or anything. These will, go after them. And there may be incentives. You sign up, then as a parent, you get $50. in your own account. So they try to get 2 accounts. It may be, I'm sure that banks will go after those that are already banking with them. Like everybody's going to want a piece of this. Now, this is not, Tanner is correct that this is not like a massive windfall in revenue right away, because it's, I mean, over 18 years, max $5,000 contributed each year, and many won't do that. But it will bring a lot of new accounts. It will bring new investors into the field. Like long-term, long-term, this is a really nice thing for Robinhood, other brokerages, and even banks. So
I just want to add, because the defamation is just crazy on this podcast, just tearing me apart here. No, I'm kidding. But what I will say is that I think that it's beneficial. I think that it's great for markets, specifically this piece. Some people think that because I'm in support of InvestAmerica, that I'm in support of the entire big, beautiful bill. I'm actually sad that it's a part of the rest of the ad here. But I do think that there's been a large amount of people that have lacked in financial education. They don't understand that they can play a part in the equity of the businesses that are making all the money in America. So, yeah, I think capitalism's awesome. Anyway, the thing that I wanted to state, though, is that on the Robinhood call that we had, where I said that this was a quote unquote nothing burger, is that I didn't think that Robinhood would disproportionately benefit versus any other account. Like if someone is banking at JP Morgan right now, I don't think that they are going to say, oh, I just had a kid, let me switch to Robinhood to set it up. Yeah. Because they can offer it at JP Morgan. So I just think wherever they're currently banking is where they're going to set up these accounts. And if they want to switch to Robinhood, it'll be because of the amazing UI, not because of these specific accounts. I don't think that this is going to have a disproportionate benefit to Robinhood. That's all.
Yeah, I agree with that. I think it's going to be directly proportionate to where the parents are already. But like the interesting segment,
I laughed out of the fucking room whenever I said it the other day. So,
well, the interesting conversation I think is for the cohort of people that don't invest at all, because they're like, you know, fair game for everybody in the space to try to capture them with like some type of first time bonus or some activation campaign. But for existing investors or people who have existing accounts, there's no real benefit of me going to another broker to open my kid's account. In fact, clearly, it's counterintuitive because it's a hassle for me.
Yes.
And that's why that's one of 2 reasons why Robinhood has really benefited. So you can see their sheer number of customers, 25.8 million. This is active accounts. They have a few more as well. This is Q1, so it's a little bit lagging. But and then you can see where their age demographic breaks down. Customer age. Now this is back in their investor day, so it's a little bit dated, but it's got to be somewhere around the same. It's 35. And you look here, so this generation here, a lot of old-line brokers and banks skew towards the 44 and up because, I mean, they have the assets. The great wealth transfer is going to happen, and it'll be a slow process. But these folks don't matter for this because there's not many 44-year-olds that are having kids. There's a few. There's not many 60-year-olds having kids. Where they're having kids is in the 20 or 43 and under, and that's almost 75% of Robinhood's customers. So you already have basically 20% of America of adult population that has Robinhood accounts. No, 10%. And you have them skewing heavily in this direction. So they probably have like between 15 and 18% of this population that's actually having kids in the childbearing age that are on Robinhood already with active accounts. And they also do marketing better than anybody else, as well as incentives. So it just depends on what kind of incentives they do, what kind of marketing they do, but they're going to dramatically outperform where they are right now. Now, that's not a massive windfall for revenue. In fact, up front, it may be, there's going to be a cost to it. But long-term, what it does basically is it brings people even more into the ecosystem, and it helps them, like custody accounts for children are something that they have lacked. They need that. That's a good thing. But they also have a flywheel that they can sell a lot of other products on. So there's going to be a lot of people that are on Robinhood already that come over, and those people will be telling their friends. Perhaps there will even be referral things where you're like, hey, refer someone else that had a baby. You get whatever. They're going to outperform. But SoFi will as well. They also have that same age demographic where I don't know where the breakdown is, but they tend to skew towards those that are younger than like the Charles Schwabs of the world.
So I think I understand that argument. I also think it's kind of false equivalency because just because Robinhood has over half of their members or over half of their assets under custody in that prime target age, let's say 35 to like prime age to start a family, doesn't necessarily mean that over half of America is in that age, or over half of the eligible population is in that age, or even over half of the eligible population in that age is willing to go to Robinhood. Like, yes, they're good indicators, but right now, like the maximum that Robinhood or SoFi for that matter, it doesn't matter. The maximum that they can get is a percentage of the total pool of people that they have.
Yeah, and I think that they'll actually overperform their pool just because that market reach. Because there are, like, you have to understand, like, even the United States, I think that I looked this up. This has been a week, and I've had a busy week. I think it's close to half of Americans don't actually have any sort of investing at all. They don't have a 401k, nothing. It's like 45% or something like that are adults that would be eligible for it, not including kids. So there's going to be a lot of those that they reach. Is that going to be a massive windfall for whoever gets them? Not necessarily. I don't think that they'll need to pay a lot as far as acquisition costs, but those are future customers. Some will come, and I don't like this part, Tevis, but like the lower income and people that don't invest, it's not all of them, but a lot of them are just degenerates that are the type that go and buy a bunch of scratch off tickets and that sort of thing. They'll come to Robinhood because Robinhood will be like, hey, get $1,000 for your kid, and we'll give you $25 when you sign them up or whatever. They'll be like, sweet, $25, takes 5 minutes. And then they'll say, events contracts. I don't love that, but I mean, that's the reality is they have a flywheel that's compelling for that type of person. Also for those that are very affluent. So
I don't disagree with that at all. I think I'm really curious as to how this will be executed, because right now there are preferential, like tax havened accounts for kids for this exact reason, to help families and people who are not financially literate or want to be, to be frank, they don't take advantage of that, even though there's literally free money in the form of rebates or incentives or
like rebates and incentives is a lot different than $1,000.
Right. But like, it's not like the moment I have a kid, I'm legally obliged within the first, 6 months to open this account so that the government can know where to deposit the money. It's still like opt out, optional opt in. Right.
Yep.
And my point is if the majority of Americans, or the majority of the world for that matter, is financially illiterate, they will have less of an incentive to do so. If it was $1,000 or $5,000, they either don't know about it or they don't care because they don't value it in their education.
Well, I don't agree with that. I think whenever this goes live, this will spread like wildfire, but not specifically for Robinhood, just these accounts in general. And I think, speaking of viral things, it'll be who's at the top of the App Store will potentially go viral as well. Like Cash App might see a massive inflow of customers that also see this. But
correct me if wrong, but I don't think the Block is a proven is in that trust list. I looked for it before, I didn't see it, so that they're absolutely ineligible unless something has changed.
Well,
they can apply, but it takes a while.
They could be under. I mean, they have an Invest app. Like you can go and buy stock, and I don't.
Yeah, but they're not approved. They're not on this list. PayPal is not either. They're not going to be. JP Morgan Chase. So who's going to actually outperform for those that are not already aligned with whatever institution? It's going to be those. You're right, like top of the App Store type of names, Fintech. Basically name recognition. This is where SoFi's plan of a lot of marketing, like SoFi Stadium, those sort of things. If you hear about this, like you're a parent, you're just not savvy into finances, and you're like, well, it kind of seems like a scam. But then you recognize, okay, SoFi, yeah, it's a bank. The SoFi Stadium, maybe you know about TGL, whatever. You see the patches. Robinhood, likewise, that name recognition and that trust are going to be very vital. JP Morgan Chase will also do well with this too, versus some little podunk thing that you've never heard of. You get a flyer in the mail and you just throw it in the garbage because you assume that it is fake.
Yeah, I mean,
well, again, let's get Steven in on this as well.
I hope that that's the case. I'm just skeptical because, like, I just go off of all of the sign-on bonuses, like transfer, your finances to us, transfer your direct deposit to us, and you'll get XYZ real money return. And people still don't do it. They see it as promotional flyers. And so it's not necessarily just because it's real money that people will sign up. There's a real education piece there that I hope is like actually taken for what it's worth. Go ahead, Steve.
So I've been talking about this for almost a decade now. I hate the way that this is being rolled out. And I hate the premise around how this is being rolled out. We have a very big problem with Social Security. Right now, 2025 budget, 22% of the budget is allocated to Social Security, $1.57 trillion. There's 3.62 million babies average born a year in the US. We should be taking $7,000 per child a year, putting it in a Roth account that they cannot touch until they're 65. And after 65 years at a 9% rate of return, it'll turn into $1.895 million. You will never get that type of money or return from the Social Security you pay in your paycheck into the system. And eventually have now that $7,000 a year per child born would only be $25.34 billion a year. We spend $25 billion on pure shit every year. Nobody can debate that. We can find $25 billion a year to fund this, with the idea that eventually we will not have a $1.57 trillion expenditure into Social Security, and eventually that will just cost us $25 billion a year to fully fund a retirement instead of the way that we're doing it now, and it'll give back capital in everybody's paycheck in the future. The way that they're going about this is ridiculous, and they need to start thinking outside the box. Gerstner has talked about it to some extent to that degree. Bill Ackman is the closest one who's been discussing what I've been saying privately to a lot of people for years and years and years. And when you go through the numbers, the amount that we're going to pay in Social Security is going to continue to expand, and it's going to continue to bankrupt this country. And we need to figure out a better way to do things. And a better way to do things is getting every child excited about investing in the market and seeding it and knowing that your entire retirement could potentially be funded by the greatness of American innovation and business is the right path to go down. And this needs to be tweaked.
I will say, and I don't know a lot about your guys' specific Social Security programs, but I'm sure it's similar to most, where you're paying it in, and then at the end they're guaranteeing you some output. But the problem is to get there is not guaranteed, and so I think
it's not guaranteed, and the return that you're getting on that is bullshit.
Yeah, but the problem is,
if you did not pay into whatever the government is putting it into, and out of your paycheck, the same amount that you put into Social Security was put into an S&P index fund, and it compounded for 40 years, you would have a way bigger monthly amount than what the government is going to pay you.
Yeah, but
I get that.
Isn't that a problem that they cause themselves, though? Because they use that Social Security money, they spend it essentially, and it's like robbing Peter to pay Paul. And that's also why they put restrictions on age for Social Security, because it's like a cost. Like half the people die before they even can reap nearly the full benefits of what they can.
Right now, you can start taking at 59.5, I believe. And then it goes up to, if you don't take it until 70 or 72, you can get an extra 30% or something. I think once you hit 65, if you're still working, you're putting in, you get an extra 8% a year for like 5 years or something like that.
Yeah, but a reasonable part of the problem, like the reason why you're robbing Peter to pay Paul or whatever, is because the accounts have underperformed what they thought they were going to. So then they're in a deficit, but they've agreed to pay people into the future. So if you go out and you're compounding the S&P over 40 years, what happens to the cohort of individuals who are retiring during a market crash? They are going to feel, people who are completely financially illiterate, that they have somehow been stolen from. Okay. And although they're supposed to retire on 1.9 million or something, and then they're actually retiring on 1.1 million, and it's going to drain so much faster. What do you do for those people?
That 1.1 is still going to be much more than they would suck out of this system with their regular Social Security check, Tanner.
Yeah, but still,
no. Hold on. The max. I'm going to Google right now what the max is. I think the max is like $3 or $4 grand a month for Social Security. It's nothing crazy. You're not, even if you have 1.9, it goes down to 1.1, which would be a ridiculous decline in the market. Sucking out 48 grand a year isn't going to make a dent in it before it rebounds.
which is
Like,
crazy.
there's no way that this way does not work way better than what we're doing.
Like
Yeah.
considering the rate of inflation.
No,
over
I'm not
lifetime,
saying that. But the problem is that the guarantees of return is what's causing the problem. It's because not every year they can guarantee that level of return. And so they have to continuously up their risk or try to change their strategy, and then they get in massive deficits.
So the maximum is $4,018, and not many people get the maximum by any means. And what I'm saying is it should all be privatized.
Yes.
Like,
What
this
is it?
system does not work because there are too many people that are getting $800 to $2,000, and that's all they're getting, and they still have to be on Medicaid, Medicare. Like, if we can completely build a different system. Now, it may take 40 years to completely materialize and no longer have that $1.5 trillion expenditure, but that's better than not doing anything and keeping it the way it is.
And I think that that's what this really is, Steve, is it's a pilot program for 4 years. That's easy to pass, low amount of money and everything. And once people, hopefully see like, hey, this is working, this is a good idea, that's when it could potentially be a replacement vehicle for Social Security. Now, like you said, you cannot phase out in Social Security like that because, I mean, it's not right for people. People should not be counting on Social Security at all, but there's plenty of people that for whatever reason are in essence, and they can't have paid into it for their entire life and get zero and just like, well, you got to work until you die. So,
And that's why it'll take 5 decades to get away from Social Security.
it's going to take multiple decades, but it can be like that. Those kids that are coming up with these accounts, they're still paying into Social Security. They got front loaded because hopefully more than $1,000, but $7,000 or whatever is put in their account. It could be over multiple years, break that up, whatever. Because there is some criticism too with people. It's such a small amount, but like the nice thing about this, Steve, is it also allows time to work the kinks out of the system before it really goes live with serious money, if that's the way that we go, and hopefully it is. One of those things that I didn't consider and is that some kids will be much, much wealthier than others. If they hold on to this, not just through 30, but they roll it over and they take it out at like 65, just because when they went in, they were buying peak S&P 500. Then there was a big crash versus those that came in and were born at the right time. And hey, it was like at the trough and they phenomenally outperformed. One way to alleviate that is instead of and it doesn't make it perfect, but instead of a one lump sum payment, you do it over 5 years. So it's like dollar cost averaging basically. There will still be an inequality, but I mean, there's no perfect system. But yeah, I absolutely agree with you. Like Social Security is not sustainable. Everybody knows this, but it's politically too much of a hot button thing right now for anybody, including Donald Trump, to tackle. So
it's not a hot button thing. It's a very simple way to fix it. Like, this is not hard. It's not rocket science. Give me 30 minutes. I'll have a full blown plan that'll work. Like, this is not freaking hard. Somebody just got to have the balls to do it.
Yeah, I think that the initial amount needs to be larger, but then like I think the holding period is
7,000 over 65 years at 9%. That's under the S&P return.
I know I'm talking about the 1,000 that you can pull out at like 22 or whatever. Like, that's not enough. But I think that if the goal is to replace Social Security for the next generation, you could start at birth, and throughout the course of someone's career, the amount that they would put in Social Security, they are mandated to fund this same InvestAmerica account through their working years. And then you just drip that all the way through. And then you can just live off the dividends in a very, very healthy way over by the time retirement age comes around.
I mean, you could also, instead of using the Social Security payment from your paycheck, instead of funding a 401k, you could just throw it into this also. And have a mandatory 3% of your paycheck, and then the rest of whatever the annualized allocation that you're allowed to invest, you can choose to either put it in this or in a 401k. But either way, the reality is 1.57 trillion, which continues to get bigger. We have to do something sooner than later. And spending $25 billion a year when we spend that on the most ridiculous stuff is not a big expenditure to set the future generation up for success and get them excited about entrepreneurship, business, and American innovation. And you'll see a huge increase in patriotism if you do that, and people think that they're going to be able to afford retirement before they even start working. Like, there is a better way to do this.
Yeah, I think you're right. I don't think it would all be stock. Like, I think the numbers that you're putting up would not be quite accurate. I think a lot of it would be fixed income, more diversified, probably real estate investments as well. But yeah,
there's no reason to do that. You put in the S&P. Fixed
I know.
income and REITs, ridiculous idea for people that age. It's ridiculous. Not
Say that
only
again?
will you want every child to be invested across the 500 largest companies in the country.
No, I agree with that. But I also think that as you age, like there's lifestyle investing where equity investments start to fall and fixed income makes
Hey,
up
guess
for.
what? The 64-40 portfolio is trash. Okay. Everybody learned that a couple years ago. Most people have known that know about investing. Anybody who invests in 60-40 is crazy. Look at every dip in the market.
I'm not
gets
talking about,
bought.
but you're
Every
not.
dip in the market goes up. The market continuously goes up because earnings expansion happens. And guess what? When there's a big correction, bond yields and bonds go down value. Happens.
Let me show you guys the non-bank trustees real quick, just so you guys know, like if you're curious, you can look this up. But so every single bank, so real quick, the banking license, banking charter has been a liability for SoFi and other companies in some ways. This is one area beyond lending that is a real advantage, is every single bank is eligible, and then just a few others. And so some of these I've not heard of. Some of these are clearinghouses, which frankly, they're not going to be a part of this. They don't have individual accounts. Axos already is a bank, so they don't, that doesn't matter. Some are very niche, and I would expect that they will continue to be niche. I don't know what that is. Of course, you have your Citigroup, which is already, it's well known. But if you go through here, like a lot of these are just banks or very specific niche type companies, and there's not a lot of them. So banks actually have a very good advantage here. This is, by the way, I was incorrect. This is not the same as Bill Ackman's Pershing. RBC is there. It's a bank. Robinhood is there. So it's Moody Bible Institute. It's niche. So, and whatever the Ukrainian National Association is, I have no idea. Others will certainly apply to it, but it's mostly going to be banks. Tanner's right, unless there's substantial reach and name recognition, and that's Robinhood. And of course, they'll have a sub bank, not directly, but yeah. So it's a smaller list than we expect,
Which includes SoFi.
SoFi is very well positioned here, and it's a bank. So
yeah. This
is one of those things where people push back and they're like, "Oh, SoFi made a huge mistake with getting the banking charter." They're idiots because it hinders them in some ways, but it gives them a phenomenal advantage when it comes to lending. And they are capitalizing on that, and also with things like this. So,
yeah, I think the main benefit here for Robinhood as well as SoFi is going to be the brand recognition and the marketing benefit. And beyond that, I think it's going to be very difficult to point to something tangible because this is like a pilot. And at the point where this is not a pilot anymore, it's going to be like there's more than enough new customer acquisition on both of those companies for this to be a blip. But the brand recognition, the unaided brand awareness, the fact that they are a part of this government program adds a layer of legitimacy to both of those businesses as being at the big boys table and it not being just Jamie Dimon and friends. And I think that is a more salient point to take across because at the end of the day, SoFi is like, what, a $15 billion company, something like that.
The Jamie Dimon and friends, hopefully that includes Anthony Noto these days. Bank Brothers.
That's a podcast name waiting to happen, man. Jamie Dimon and friends.
Yeah.
If he joins us, that's what we're renaming. So
yeah, you could change the whole course of this podcast with one episode.
Yep.
What do we want to? I want to get away from this InvestAmerica thing. It was great, but let's move on. Why don't we talk a little bit of Tesla really quickly? I found this fun little video online. Maybe you guys have seen it circulating, but this is the beautiful Austin, Texas, where there's a Waymo. And in the rearview mirror, there's also a robotaxi. Isn't that nice? On the same road. And you can see as he zooms in, no one's driving it.
The future.
the future. What are your guys' thoughts? I mean, is this actually going to come on the 22nd of June? Is that going to get pushed?
Didn't they just file? I saw this just broke today. Let me see. Yeah, the Department of Transportation's automated vehicle deployment website now has a Tesla robotaxi option.
Yeah, so from what I saw, that they put out a new list as well, or sorry, a new application that will actually allow for quicker approval, and that they're going to try to adapt to autonomous vehicles because they're coming quickly, which means we're probably going to see more competition much faster, which is nice.
Yeah.
Is that the NHTSA news today that screwed over my covered calls?
I'm not sure.
Is that what that is, Tanner?
It was. Wait, let me see.
So there were, I did see a piece of news on automated driving, and basically there's some regulation that's being passed. It looks like on a national level, it'll make it easier to get approval for that.
Yeah, it was the NHTSA news. Sorry, go ahead, Roy.
Well, yeah, that was the main thing I'm saying. I'm actually pulling up something here too. One of those things that it's a few weeks old, but they're heading in the direction of having vehicles starting in Austin just deliver themselves. And this supposedly coming in August, we'll see. It may be a little bit longer than that. And I was like, hey, this is pretty cool. You know, it shows off the technology and everything. But what's really substantial about that is if it works in Austin, they're within range, easy range of all the major metroplexes. Like I would have to look it up again, but there's something called the Texas Triangle, and you have Dallas, Fort Worth, San Antonio, Austin, and Houston all there. And so you have like 75-80% of Texas population. That's the second largest state, concentrated within striking distance of that Austin manufacturing hub. And so they can deliver themselves. Now, how big of a deal is that? Well, it's a pretty big deal because there is on Teslas a delivery fee that I was like, oh, maybe they can reduce it. Maybe they can end up doing something different with it or giving some sort of incentive. They actually can't. I actually found out today, and I was wrong on this because we're looking at buying a Tesla ourselves, that I think it's a $1,790 fee with a few rare exceptions is federally mandated. And so this, if they're able to deliver it itself rather than, load them up on trucks and have somebody do all that as far as logistics, just goes straight to the bottom line of Tesla because, hey, it literally drives itself out of the factory, parks itself until it's ready to be sold, it's sold, then it goes directly to the consumer. And that's just amazing. It's a massive, massive thing that nobody is talking about in terms of Tesla.
I think it's very exciting. Waymo's doing a similar thing with driving right off the lot and picking people up within 30 minutes of driving off. You can go pick a customer up immediately. Autonomous is going to be a really big unlock. I think the market already knows that, but I think from just a general, like how much that's going to change your life perspective, I think it's being very underappreciated. I think it's going to change everything, but
you're hyping this up way too much.
Just because you like driving yourself around does not mean that I am not going to sell my car whenever.
Don't work. You said it yourself, $1 a mile, right?
Yep.
That's what they're shooting for, $1 a mile. That does not get people to not have a car that actually drive.
Yeah, but not everyone drives to that degree. And including that, I think it does change your life if you can own that vehicle that also self-drives.
When you look at how much a car payment is and how much insurance is and how many miles the average person drives, it doesn't even come close at $1 a mile. Now, for people who work from home that need to go here and there, it makes sense. So for you, I understand why you have this idea. I drive in one of the most heavily populated areas. Everybody freaking drives a ton of mileage.
I get that. But
hold on. There's a reason why the most common leases are 12 and 15,000 mile leases. There's a reason for that. Autonomous is going to be great when it actually hits and insurance policies allow it, because people will opt to buy a Tesla because of that and pay for the package. because they don't want to drive. I will agree with you on that. I will be buying a Tesla. My father will be buying a Tesla. But until that actually happens and you're allowed to do it, we will not be buying Teslas. Now, from a revenue standpoint, we are assuming that Tesla is going to break through in this. The entire ride hailing market is between $300 to $400 billion a year. It is not expected to get past 500 billion by the end of this decade. That is research from several marketing firms. I can pull it up because I've cited it at least 5 times in Tesla articles. A lot of the cases around ride hailing that I've seen are citing numbers that are bigger than the entire market's supposed to get to. Now, Tesla is not getting 100% of this, nor are they putting Uber out of business or Yellow Cab. Now, those entities may buy a Tesla for those purposes and recognize the revenue from it. Maybe there'll be some split, but this is not going to be some big revelation for Tesla. Optimus is going to be so much bigger than autonomous that autonomous is going to be a blip in the radar.
I didn't make that statement though. I said that I think that autonomous vehicles are going to change the way that we live. I'm saying you could own this self-driving car, pay $99 a month. If you do more than 99 miles, there you go. There's your less than $1 a mile. And be on your laptop in the front seat rather than having to focus on the road. I'm just saying I love the
100%, and I will be getting it for that.
Yeah.
No question.
I think it's going to make a massive difference to our lives. We spend too much time behind a wheel.
It's going to make a tremendous difference to our lives. The problem is most people are looking at this like this is going to be a $500 billion or $1 trillion revenue segment for Tesla. It's not getting there anytime soon.
I think Kathy thinks it's a $900 billion market in 2029.
How much?
$900 billion in 2029.
That's what ARK is saying, right?
Yeah.
Yeah. Outside of people who are Tesla owners paying for the package, if you put that aside, there's a 0% chance of that happening. The entire ride-hailing market is not supposed to get past 500 billion by 2030. Like 0% chance of that happening. I don't know how many Teslas are on the road. Do we know how many Teslas actually sold in their entire lifespan as a company?
Like 5 million.
Know that.
5 million, 6 million.
Yeah, I was going to say 7 million. Didn't they just recently announce that they did 10 million total produced cars, but I don't think they're all on the road still.
All right, so let's just say
like 5 million.
So let's say 10 million by 2030. Okay, let's say everybody gets it. So at $1,200 a year for that package, that would be $12 billion of revenue.
Just add the zeros, bro.
Yeah, it's late. I don't want to say a bad number. And I need to actually do the currency to see where the freaking commas are. 10 million at $1,200 a year is $12 billion of revenue. There is no way this is becoming a 900 billion revenue segment. There's no way.
I agree with you. Does anyone disagree with you on this panel?
That's only assuming that, first of all, the fleet doubles in the next 5 years, and every single Tesla on the road opts into this package to be autonomous, which is like highly doubtful.
Yeah, you could put 25 million cars in it, and that would be 30 billion in revenue.
Like exactly, right? Like I know pretty much everyone like in my family would be like, no, I don't want some like strangers being in my car all day long and my car driving them around. Like they see their car as like an extension of their house or like their property, and like, you know, these possessions that are transcend this just material object kind of thing. And so a lot of people will see the utility, and a lot of people will have that emotional attachment to their vehicle with like, I don't want strangers driving around, you know, like my family is also like I've been trying to get them on Airbnb for a while, and they're like, no, like just the idea of it being their house. So I don't think that you're going to get nearly that level of adoption rate across the entire fleet.
And here's the other thing with that. And I agree with you, Tevis. Like when I buy a Tesla, 0% chance I put it into a ride hailing thing. Nobody's getting in my car except for me or who I want in it. That's one. Two, we do not know if the insurance companies are going to pay claims out or try to push that on Tesla. If it's a robo-taxi, like that's a big thing.
No, but that will get figured out.
Insurance.
That'll
It'll get figured out,
pretty
but we
quick.
don't know how it's going to get figured out. If a Tesla gets into an accident in a robo environment, who's liable? The
Yeah, but we're
person
literally
whose insurance policy it's on.
we're
Where's the
going
Tesla?
we're going to see those claims in the next few months. Like, I mean, the insurance
Right.
questions honestly are not even a concern for me at all. Like
And
they'll
they
be figured out
should be.
so fast.
They
So
should be.
Steve, let me get you going a different direction. Break out your calculator
I got Excel open.
and throw this up, please. So just so we can see revenue, the revenue on the car side, you see total automotive revenues
Yep.
right there. So now this isn't like a massive well, I guess I'll let you do the calculation. So
Just tell me what you
$1,390 is the delivery fee, unless you're like really far away.
How much?
I'll be right back.
$1,390 per vehicle. Now, if the car basically can just drive itself from the lot to wherever, that Tesla still has to charge it. It's federally regulated, mandated, whatever.
Mm-hmm.
Maybe they cut the cost of the vehicle, but let's just say that they bank it. And let's just say that 5% of the vehicles that they make are able to do this. Now, I think it probably will be more, given where their hubs are in Texas and Austin, Texas. They're reaching about 75% or so of the population of Texas, and also in California. But let's say 5%. So they had 336,000 vehicles that were produced, or that were delivered rather, in quarter one.
Okay.
And so let's just take 5% of that and multiply it by 1,390. What do you have?
You have $23.35 million.
All right. So every little bit, helps and is accretive. It's not like a massive thing, but as they continue to build out more and more of this infrastructure, if they get like 10%, or if they even get up to like 20%, just through some local hubs, like that's not. With Tesla, it's not just about the robo taxis. Like I agree with you. Like it's not going to be a massive growth lever, but it'll be accretive. Energy is growing, services is growing, insurance is a part of that. That is certainly growing. When the vehicles can self-deliver, they save some money on that. They are scaling the Model Y. Wright's Law comes in impact, so you'll see COGS savings on that end. There's just a lot of things. And interest rates, that's the other factor too, that hopefully interest rates will get cut down. I don't know, maybe it's higher forever, who knows? But there's a lot of things that will be accretive for Tesla to help them start going in the right direction. They're still trading like wildly expensive, I think. There's a reason why, and also really Elon antics, that I took a lot of Tesla off the table. I didn't want the risk. Yeah, so far I'm underwater on that trade, but I hear what you're saying, but there's a lot more going on than just robo-taxis for Tesla near term. And robotics is really what has me excited, but that is further term. So what I'm doing, and I don't know if you saw this post or video, Steve, but I'm treating my Tesla position like I would treat an unprofitable biotech stock. So what I'm meaning is it's a 1% allocation for me, that if I lose it all, no big deal, it's 1%. I could go up to 1.5%. I'm fine with that. Even though it's profitable, I know they have a real product and everything. But if they get the bots right, which is not near term, it's zero revenue from bots, and that's why I'm treating it this way. If they get the bots right, there's massive upside, even with that 1% allocation. So that's what I'm doing, is kind of de-risking my position. Not quite going as far as Tanner, but I think it's smart what he's done.
Yeah, and Roy, look, I agree that every little bit is accretive. I agree that autonomous is going to be a net positive for Tesla. The thing that annoys the shit out of me is that nobody on this stream, but so many things that I say on X and in Tesla articles is just how out of proportion they blow the autonomous TAM. And there's a lot more stuff that they can be talking about, such as cross-licensing it to other companies. Because if Tesla really is the way, instead of the way that Waymo is going about it, and they cross-sell to Ford, Mercedes, and whoever else, that's going to be huge also. So there are a lot of things that are really beneficial to Tesla, but the ride-hailing thing is just ridiculous when people talk about how much revenue that's going to generate. It just sets me off.
Let's can we switch the topic a little bit? Go back to SoFi?
Fireside.
Fireside.
All right.
Go
I'm
ahead,
going
Roy.
back to leveling.
Sorry?
Yeah. So the previous Fireside, not this one.
What did Steve say real quick? What'd you say?
You heard what I said. I put it on mute for a reason, so you don't hear me pounding the keyboard.
Oh, yeah, he's okay. He's gonna go play WoW now. Okay. Sorry, Roy, go ahead.
So yeah, this was a much better Fireside. Now, the previous one, which was William Blair, all they did basically was go through their earnings, which was I don't know, like there was almost nothing of value there. This time, Chris LaPointe, he was on point and absolutely delivered a lot of like very concrete numbers.
Yeah.
Like a couple of the quotes that stood out to me, and I guess I'll share this too. I've got a synopsis from Quarter. But I liked this right here, loan platform business. This is the first time I remember seeing this. Maybe I missed it before, but we expect the loan platform business to be a $1 billion business on an annualized basis over time, and we're well on our way. That's not a 1 billion as far as lending because they're talking about volume already. That's way past that. That's in terms of their revenue as SoFi. Like that's massive. They talked about the student loan TAM. Another securitization. I think that this is separate. Maybe Tanner or Tevis, you guys can weigh in because we didn't get an announcement or anything. So that was the first time that I saw that.
Yeah, can I weigh in on that real quick?
Yeah.
You misquoted it a little bit. The 700 million securitization was funded by loan platform business partners. So it wasn't SoFi's money, which makes it even more exciting.
Okay.
Because not only are they writing loans for their customers, they're also helping them sell it off as well, which they did last time too. So this is their second loan platform business securitization for $700 million. Like really exciting. But it was filled with a bunch of great stuff. They thought that they were going to grow in private student loan market share, but they have 60 to 70% of the market already.
Which is insane.
Yeah.
And not only that, like the credit box expansion outside of unsecured personal loans into like home equity and student as well. Like I thought that was interesting where they were saying that the demand is finally starting to appear outside that credit box that allows them to diversify a little bit of the deals that they can strike through the loan platform business, which presumably put two and two together, you could imagine the loan platform business really accelerating in the growth rate as a result of that.
Yeah.
Rado has a good point that if they get this, and it may take years and years to get to that 1 billion annualized rate on the loan platform business, that's $1 EPS right there, just from that. Nothing else from SoFi. It's like they're so well positioned. That's not like them banking on rate cuts and like a lot of people that don't follow SoFi, they think, oh, it's all about like rate cuts and stuff. I mean, it helps. It helps a lot, especially with the student loan refinance. They talked about the mortgage product as well. Like those are things that are just going to underperform until such a time we get into that. But and yeah, the tech platform too. He said, and this was alluded to, I think, in Q1, but he said it in a way that it clicked with me. Was we also have about 10 deals right now that did not contribute in revenue in Q1, but we do expect to contribute in 2026. It just there's a long lag between when there's a deal made and they actually see revenue.
Yeah. I was very, very pleased with everything that they said there. Once again, guys, I'm so sorry that I didn't put it in my draft, but yeah. And
We have Roy and Tevis weigh in on all the picks.
What'd you guys think?
I mean, I saw the video. Do you have the list?
I'm pulling it up.
Yeah, I have the list.
There you go.
I have no idea what you guys are talking about.
It's just really cool. I think we should do one too.
You need it zoomed? All right, hold on.
All right. You know what?
They did like a.
Well, use mine because the dividends are in there. Don't use yours.
They did like a fantasy draft, Roy, where they picked stocks.
What do you think about everyone's list?
I mean, Amit's looks pretty good, except for Grab and Apple.
Dude, Amit's is literally the worst.
And Duolingo. Actually, It starts off well and then it just goes downhill. Never mind.
Oh, so Roy, one caveat is that the time frame is 12 months. So that's why Tanner is saying Emits is the worst.
That's helpful. I thought it was longer term.
I kind of agree with that. Like Amit picked fan favorites, but they're all fan favorites because they've accelerated so much over the past
Yeah, they're all super expensive.
Yeah.
See,
I really like Matt's.
I like Matt's, yeah.
I'll never question Chris's picks.
Yeah.
So
Chris's is just weird, man. Like they're like picks that I wouldn't like string together.
they're all turnaround. Like he loves turnaround plays. I'm not saying they're all that because obviously, but like they are catalyst and turnaround based. That's what he's looking for.
I think Steve's are actually really strong.
Take two. I think the
Steve's are good
is going to be priced in. I like Steve's and I like Matt's.
Okay, so this is like 12 months from now, right?
From the close on Monday.
Oh man, yes, Steve's got this.
Yeah, yeah.
Well, Roy's a little biased. He sees that PayPal and he just
Well, so I'm looking at value. Like I'm assuming this is an order of pick.
Yes.
Yeah, PayPal that far down, 12 months out is ridiculous.
Yeah, I don't agree with that, but the only thing that I wish, and it still might happen, I'm really trying to get Matt to change. I should have had SoFi on my list. I really didn't think anyone was going to pick it. That's why I lost it in the draft. I was trying to snipe new. So this is actually a little out of order. Like the way we actually picked was I was first. Like I had first round pick across anyone. So that's why I was able to get NVIDIA. But then the next round, I was last pick because it shifts over one each time.
Everybody pick from each position twice.
Yeah, what was the original list? It was like me.
It was you, Amit, Matt, Chris, me.
Was there some stocks that were not available, or
Yeah, only 120 names that were picked.
Because I was like, I saw some. I'm like, dude, why didn't they pick this? So yeah,
Matt, Steve, Chris. Is that what it was?
Yeah, you, Amit, Matt, Chris, me.
Okay. But then every time that we went, so like Amit went second. Amit went second, but then the next round he went first. So
then Amit was then last, and Matt was first, and so on and so
Exactly.
on. Everybody picked in the same spot twice.
It's crazy that SoFi went in round 3.
yeah, first round of round 3.
I think that so in order, I think that I like Steve's, then Tanner's, then Matt's the best. Chris's I actually like the least, just because he does have a lot of turnarounds there. And I know this from experience, turnarounds can take a long time, a lot longer than 12 months. And I don't like UNH being the number one pick. Like I think that's a terrible choice. Like if you're in the later rounds, maybe Eli Lilly, Novo Nordisk. I mean, they're not turnarounds. Elf is though. Marvell should be okay. Google will be fine. But like these are not, I think his is the worst. Now I could be surprised, but
Tanner, can you share my screen instead?
Yeah, it's absolutely Steve or Matt that's going to win that.
I think it's
Not
hilarious
absolutely. I think I have a really good chance of winning.
that Tanner has a bigger total return on average yield. Oh, wait. No, he doesn't. I'm sorry. I didn't zero out that one. Chris actually has a 1% average yield across his
No one can see
portfolio.
anything because you're not zoomed in at all.
I'm not zoomed. What do you mean I'm not zoomed in? I can see everything on your screen fine.
You're looking at a 49-inch monitor. Most people that are watching this are watching it through their cell phone.
All right, fine. Go back to your screen.
You got some really good value later there, Tanner, with Mercado Libre, I think 4th round, and then Shopify 5th round. Like that's
I want to get rid of Shopify, to be honest.
Mm-hmm.
Hey, I'm willing to deal HIMS. Nobody wants to take it.
I'll do HIMS for Shopify.
No, that's
Well,
done.
then
Why are
Leave me
you
alone.
willing to let go of HIMS, dude? That's like your growth in your portfolio. Like
So I took HIMS specifically because I thought other people would want it and I could deal it to somebody for something that was
dude.
taken that I wanted.
HIMS and Broadcom is the main growth drivers of your port. Meta and Microsoft are the main like anchors and like stability providers. And then MicroStrategy too is a growth. But
Yeah,
you
I
need
mean,
HIMS, dude.
I got a little risky with two of the things because they were at all-time highs, but I think Netflix and CrowdStrike can continue the momentum and keep moving higher. And
It's just rude.
what's rude?
Someone said I was going to pick Joby. It wasn't on the list. Okay, it would have been my first round pick, but
We need to do this. We need to redo this.
get your own ideas.
Yeah, I would love to.
Yes,
Maybe
Kevin.
get like
Couch investor.
Couch
Brad
Investor. We get a DDI on here.
Yeah, Chris. Yep.
I will say, I think Chris has got the best chance of winning. Me second, Matt third, Tanner fourth, and Emmett last.
Man, Chris has way too many turnaround plays on there. Just way
UNH
too-
can be a double. in
I
a
mean,
year.
it could, but in 12 months.
A lot of
Or-
Congress
or-
report
okay.
on UNH actually.
UNH could go to 550. It doesn't even need to double. It could go back to 550 and be a 70%.
I am
Google
so
could be
surprised that you're
20,
placing me so
30%.
low.
Chris has got a strong portfolio. Now, Take Two, Lilly and Norvo, his last three picks could hurt him because biotech could stall out. And if Take Two does not release Grand Theft Auto 6 next year, tanked. That position's tanked. But I think that Amit has the worst out of all of us. And I've said this last night also and to him today. Because I think Palantir is so high right now, it's going to have tough comps this year, especially if the Fed actually starts cutting rates into next year. It's going to see their interest income decline, and it's already a $330 billion company. I just don't see Palantir doubling or going up 50% again in the next year. Hood could have tough comps. Tesla's a wild card. JP Morgan's not going to go up more than 10% probably, and he's relying on other things. And then taking Apple as an anchor was, I don't know that Apple really does much next year either with how far behind they are.
So this doesn't factor in today. It starts tomorrow, or it does factor.
Starts at the close on Monday because when we did it,
Okay.
Israel had just launched an attack.
Yeah.
So we had said that we're going to give it a couple of days to let volatility kind of shake out. And whatever the closing price on Monday is, will be the starting price for all these portfolios.
Yeah, so like half of Amit's picks are going to drag down, I think, the rest of his portfolio. That's the issue. And then there's some wild cards in there, but I just, yeah, I saw, some of his, I didn't know like how the system worked, but yeah, it's
Legit, AMD and Grab are the only things that he has on there that would be considered cheap or on sale.
I don't know if AMD is going to do what you think it's going to do.
I'm not saying that. Dude, I'm not saying that AMD is going to run. I'm saying it's definitely not priced to perfection. Palantir, Hood, Tesla, Nebius, Apple, Duolingo, those things are priced
I agree.
high.
not Nebius. No, Nebius is actually pretty close to fair value. So you can give or take. I know you can't really look at multiples for it yet, just because they pivoted away from their core business previously. So
you can't look at a company like that and say what it's fair. Like,
Yeah, I think saying fair value for Nebius is a pretty loaded statement.
yeah, how do you say that?
I mean, I sold my entire swing position in Nebius. I went through it, but I don't think Nebius is egregious there, especially in a 7th round or that's a 6th round.
Yeah.
I don't think it's bad. But yeah, Visa. I mean, it's maybe he took it just because he saw it dip so much today, but I think that will be
No, it was picked before the dip.
Yeah, I don't think he factored in the whole stable coin.
Well, that's great though. So he gets it kind of at a cheaper base, but still, I don't like it. Yeah, Oracle was a really good pickup by Chris when he got it.
Chris picked it right before I was going to pick it too.
Oh man, yeah, CrowdStrike's good though too, Steve.
SoFi was picked right before I was going to pick it because Matt said, I'm thinking SoFi or ASTS. And I was like, ASTS sounds like a great deal, brother. I'm like trying to get him away from it. He goes, no, I'll go SoFi. I'm like,
And you should have picked ASTS right after.
I don't want to ASTS.
Trade. Just to trade.
If you look at my name, I think the problem with some of Matt's names is that there's a possibility for some of these to go way down.
Yeah.
I don't think any of my names are going to go down.
That's well, I don't know about that.
I'm not saying that the market doesn't go down. I mean, but like, there's not like none of these are egregiously priced. I mean,
I don't know about
maybe, but it gets into the S&P 500.
Yeah,
Apple is highly priced.
Yeah, but it'll get in.
Yeah. So like with Steve's, I see like every single one of his picks, like there's going to probably be like 2 or 3 that end up, negative from here over the next 12 months, or who knows what's going to happen with macro. But like Steve's, I really like so much just because, I mean, they all look like some of them might be slow, gain like 10% over the next 12 months. And others, like Hims might do a double. PayPal might do, like 60%. Netflix, might surprise you guys. So his are just like all accretive, and I think really positioned well. So I think you did well, Steve. I really
I
do.
will tell you, if we go into a recession, there's no way I don't win.
So Roy,
I agree with that.
are we doing the same exercise, Roy? We get DDI, we get Brad Freeman, we get Couch Investor, and we do this entire exact exercise.
Copy it even the stocks.
Yeah,
Even the stocks.
You find the names that we use. I think it was 120 names.
I think that would be so fun. I will probably get trounced in this, honestly, because
it'd be fun. Let's do it.
It would be fun. Yeah, let's do
Are
it.
Tanner and I allowed to participate?
No, you guys already picked your things.
Why we can't? We can't. It's like having different brackets in NCAA.
You know what's funny is,
are you the guy who buys multiple bingo cards just to like scratch the same number off of like 4 cards?
No, Tevis, I'm the one that runs the NCAA pool.
Roy, you've been historically really good on the 1-year picks. So,
picking 10 names is tough, especially like I know a lot of these a little bit, but most of these, like there's probably like 20 that I know enough to know, hey, this is a great investment for 12 months. So,
I'll tell you why I think I have a very good chance of winning, and everybody wrote me off last night. I do think Meta can be at 1,000 by the end of in the year.
You're right.
Yeah.
If Bitcoin runs, like MicroStrategy is a wild card, and that's not my style. But I said, you know what? If Bitcoin runs, this is the only thing with real Bitcoin exposure. Even with dilution, this thing can do 50% next year if Bitcoin really runs.
This is not my style. I don't care too much about Bitcoin. Second pick.
No, I was playing to win. Playing to win.
What is EOG? Like, that's the only one I don't know.
It's an energy resource. Yeah.
Like Microsoft can continue to go up. Hims, who knows what Hims could do? That could do a double too. Broadcom's probably going to do 20, 30%. And then if we do get a bull market led by tech, CrowdStrike's going to keep going because cybersecurity is going to continue to be hot. Netflix is a great play for recession or in this market because they keep adding subs, so that'll probably keep going. Salesforce easily can get to 325, maybe 350. I mean, it was at like 380 or 400 not too long ago. PayPal, even if PayPal goes to 90, that's still 30, 35%.
What do you mean? Even 90? 90 is like a double from here, dude.
No,
90?
70, 71.
And he's $20.
What's PayPal at right now?
70 or 71.
Is that 70?
Yeah, literally has never touched 45, and you're like, it's a double.
Yeah, every single. All PayPal needs to do is get to 90. It's like 35, 40%.
I don't think we'll talk about this. I got a post for people, I guess just being a shill on my own channel, but and a video as well on the stable coins and the impact. But like every single thing that has to do with payments was just smacked today when Walmart and Amazon, I mean, it shouldn't be a surprise. They're like, hey, we're considering issuing our own stable coin. Won't go into the details on that, but I mean, it shouldn't be a surprise for folks. And the market doesn't really know what to do as far as like who's winners and losers and who's going to lose the most potentially from that, or if it's going to happen. So it just out of caution, like sold everything off. Like Visa was down like almost 6% today. MasterCard same. Like that's shocking. PayPal down like 5.5%. SoFi also hit because of Galileo. It's a one day where SoFi is perceived as like, oh yeah, Galileo exists. It's like, okay, just for one day you could forget, one more day, but whatever.
These were the names, by the way, that we were able to choose from.
I really do like the App 11 pick though, Tanner. Like that was sneaky good, I think.
Thank
like
you.
Yours is good. On it. No. I mean, I think it's just because there's the perception like this ran hard, and so it's got to stop and cool down. You look at the multiples; it's pretty reasonable, and you look at the type of advertising that they have. It's not going to be disrupted over this year. I don't think it's going to be disrupted over the long term either. But yeah, it was Starbucks. Yeah, nobody picked that one up. SMCI.
Yeah.
Oh, Uber. No one grabbed Uber?
No one grabbed Uber.
I know it's at its all-time high, but yeah.
Is that stock listed twice? What is it?
Yeah,
Oh,
it's listed
Lemonade?
twice, but it didn't affect it.
Wait, no one picked up Lemonade?
No.
That's what I'm saying. That's
Wow.
crazy.
Like,
I don't want
picked
lemonade.
Oscar.
Roy,
Matt picked Oscar? Yeah, Matt picked Oscar Health.
right.
all that. I'm looking forward to this. This is gonna be fun, man.
Yeah, let's do it. Maybe Sunday or something. We'll see when Chris has time.
Yeah. You know what? Sunday I actually it's Father's Day, but I have the afternoon off. So if the other guys do, I don't think DDI would.
No.
No, Chris would never be able to do that.
Yeah, not on Father's Day. No.
Yeah, we can aim, maybe next week's at some point or the week after. But yeah, sometime soon. Yeah, that'll be fun.
Cool. Shall we wrap there?
Yes, ladies and gentlemen, thank you all so much for joining the FinTech Friday show. If you guys liked it, please subscribe to the channels. But until next time, bye for now.